All right, so this tends to be the topic in chapter 14 that gives students the most trouble. It's basically looking at some of the different ways that we can calculate ROI. We're going to be using that first ROI formula that we learned earlier, which is our after-tax income divided by those invested assets. So you'll notice that for each of these, I kind of have a little bit of a chart going on. Historical cost versus current cost, and net book value versus gross book value. So let's talk a little bit about those differences, because it is going to change how we do everything up here based on this ROI. When you think about historical cost, what do you think about? Do you think about revenues? Do you think about assets? And I'm hoping you think about assets because of that historical cost principle. We always value our assets at historical cost. So what we're going to be doing here is we are going to be using that historical cost information, and then we are going to be calculating ROI based on that historical cost information. So let's go ahead and get started with actually, let's pause for a second. Now let's talk about the difference between gross and net. Hopefully you remember the difference between gross and net. When we're talking about gross, we're talking about the total amount. When we're talking about net, we're talking about the amount minus something. So when you're thinking about book value, try to think about the formula for book value that you learned back in Accounting 1, and hopefully again in Theory 1. So book value is the cost minus the accumulated depreciation. So when we're talking about net book value, it is following that formula. However, when we do gross book value, it is actually adjusting based on no accumulated depreciation. They want gross, they want the full cost. So let's go ahead and start just jumping right in when it relates to ROI. So the first thing we need is after-tax income. This problem here does tell us the different amounts that we have for our operating profits before depreciation. And what you can assume here is essentially this is our after-tax income. There are no taxes in this problem, so it does give you a bit of a break. But it's basically everything before depreciation cost. So our depreciation expense isn't calculated there yet. So we are going to have to adjust that later. So really, when we're doing, let's start with this box right here, I guess. When we're doing the historical cost method net book value, we'll do it for all 3 years, 1, 2, and 3. When we're starting, we know that our after-tax income before depreciation, we're going to have to keep that in mind, is 200. Sorry, thought I was going to have something going on with the dog. 240 and 288. Now, once you have those operating profits for each year, I then recommend that you go ahead and you figure out the cost. Now, this one is using the historical cost. Now, they're telling us that the asset cost at the beginning of year one is $1,000. So we already have our asset cost of $1,000. And since we're using historical cost, that does not have to be adjusted. We want to keep it at that historical cost. All right, next. So we have some pieces, but we need to make sure that we don't have to deduct anything out here. Since we are looking for our after-tax income, we need to get rid of any depreciation expense. So let's take a look. Straight line depreciation is used, and it's based on a 10-year life. So this $1,000, we're going to be getting rid of it $100 at a time. So for year one, that's going to be $100 of depreciation expense. For year two, we're going to take off another $100 of depreciation expense, and then year three, $100 of depreciation expense. So now that kind of gives us a little bit of a better view of what the after-tax income is, or our income after all expenses would be. Now, since we're using the net book value method here, we're going to have to take out accumulated depreciation here. So after year one, what is our accumulated depreciation? Well, we have only depreciated $100 of this, so we have $100 of accumulated depreciation. And this is where it's very important where you understand the differences between depreciation expense versus accumulated depreciation. Remember, income versus invested assets. Our depreciation expense is an expense. Our accumulated depreciation is a contra asset, so they are very different. So in year two, how much depreciation do we have in accumulated depreciation? 200. 100, 100, that gives us 200. All right, and then year three would be a total of 300. Right? So now we are left with 100 divided by 900, 140 divided by 800, and 188 divided by 700. So let's calculate that out. So we have 11.1%. Seventeen 17.5%, and 26.9%. So those would be our ROIs for each year if we were using the historical cost and net book value methods of doing this. Now let's go ahead and go down to gross book value. So again, follow the same steps as I had before. First, write down all of your operating profits before depreciation. So we had 200, 240, and 288. All right, next, write down the cost of your asset. Again, we're using the historical cost method. So we don't have to adjust it for the current cost of the asset. So we are just going to be putting down 1,000, 1,000, and 1,000. All right, so even though we're using the gross book value method, which means that we're not going to have to put any accumulated depreciation down here, we're still going to have depreciation expense for the year. So we do have to take out our depreciation expense. This gross book value focuses on the denominator, not the numerator. The numerator, we still have to take out that depreciation expense. So still $100 per year. So we are left with 100 divided by 1,000, 140 divided by 1,000, and 188 divided by 1,000. So we have 10% and 14% and 18.8%. All right, now make sure that you really understand how to do this using the historical cost method first. And by the way, there is a reason why I say write down your operating profit before depreciation, then write down the cost of the asset, and then work with your depreciations depending on what method you're doing. Because once we get to current cost, we're going to have to take into account the current cost of the asset. So spend some time making sure that you understand this first, and then go on to the second video, which covers current cost for both of these different ways.